I want to work at the nominal basis because that's where our listeners and our viewers are at. Forget about Fed talk. Forget about real inflation. How do we withstand a nominal inflation rate of 8.6%?
Well, Tom, I think this is exactly what you end up getting when you run the nominal economy hot at double-digit growth rates on average since the bottom of the business cycle in 2020. Any look at historical experience will tell you that. And unfortunately for households, if we look at the May data, the proxy for nominal income out of the jobs report, which is essentially just wage growth, hours growth, and employment growth summed together, annualized it at about 10%, all of that being eaten up by inflation with today's report.
That's where I wanted to go, Mike, and that's what I was watching was real average hourly earnings, both on an hourly as well as a weekly basis. On a weekly basis, it is now the most negative that it's been in data going back to 2006, negative 3.9% in terms of how far behind wage inflation is falling behind the actual stuff we buy every day. What does this do to your growth outlook, Mike?
Yeah, I think unfortunately, we're dealing with a little bit of a stagflationary environment here, at least for the month of May. So obviously we've had some intensifying shocks in food and energy prices. So hopefully at some point that will reverse. But, as Mike McKee went into, this is an inflationary process that has been broadening and deepening out. So you've got pressure on rental inflation. That's a significant portion of the CPI. If we look at services inflation, excluding energy, that's 60% of the CPI, it's running at more than double the average of the last business cycle. So it might be a bit of a fool's errand here to just assume that if crude oil prices back off, all of a sudden a magic wand is waved and the inflation problem simply goes away.
Mike, we thought that we had seen peak inflation. We had not. We now have an even higher print that is a new post-1981 high. Is 8.6% the high water mark, or are we going to see even higher ahead?
Well, I think we're probably pretty close to peak inflation on a year-over-year basis, but none of that may matter for the path of Fed tightening and the bond market and equity market valuations, because if inflation eases from here but still stays very high, then that is not an environment where the Fed just moves to the sidelines and we see some kind of huge revaluation in expensive equities that dominate the market cap of the S&P 500. So there are some macro commentators making kind of bizarre arguments, at least from my perspective, that aren't focused sufficiently on the nominal GDP backdrop, which is still way too strong. Aggregate demand is still way too strong, so the Fed has more work to do. And the fact that if inflation eases but is settling in at rates that are several times the Fed's target acceptable inflation over time, then that's still going to be a problem for the bond market and a problem for the Federal Reserve.
Well, and, Mohamed El-Erian, who was on yesterday with John Farrow, said, if you think we're going to have a recession, sure, inflation's going to come down, and I'm paraphrasing here, but that's not what you want to see, right? That's not how transitory inflation should be affected. So is that the way we're going to see it?
Well, Matt, I think unfortunately, eventually that's where we probably end up. But the critical discussion is timing there. So I don't think that we're in a recession now, and I don't see a recession this year. I think the recession will come after the Fed gets itself into a restrictive monetary posture. And that's going to take some time. Consider this fact. Forget the backward-looking numbers that we just got, as shocking as they are. The Fed funds rate relative to 5-year expected inflation is still below 200 basis points, minus 200 basis points. And that is below the trough of the last business cycle when you had very slow growth and very weak realized inflation. And so this Fed is still behind the curve, and that is going to create a situation where these underlying drivers of inflation, like services and rents and wages, are likely to continue accelerating.
Well, Michael Darda, that's right where I wanted to go, because frankly, folks, the most important inflation data of the day after this shock is at 10 a.m. with a five-year forward Michigan statistic. Michael Darda, what are the ramifications to the economic zeitgeist if we get the 5-year Michigan look to break out above 3%, to break out of the inflation level of 2006?
Yeah, I think the FOMC would take note of that. Those measures are a bit stickier than the bond market break-even measures, but they are elevated marginally relative to their averages of the last cycle. And if we start to see any kind of what looks like a breakout, I think that would create a lot of consternation on the FOMC that these high headline inflation numbers are bleeding into longer term expectations. And, I think the Fed would be alarmed by that.